Good afternoon, everyone. Thanks for joining the final panel. Pullback or rally? I guess, is that really a question? We're all mining investors, so we're probably in the rally camp. I have a interesting panel with us today, so maybe I will start with each one of them introducing themselves and their firm and what they do, and then we can get onto the topics. So maybe. Coille, would you like to introduce yourself and your firm?
Hi, my name is Coille van Alphen. I'm a portfolio manager at Equinox Partners, which is based in Stamford, Connecticut. We're a value-based hedge fund managing just under $1 billion. And I've been investing in this space for about, 15 years at this point.
Great.
Dan Oliver, founder of Myrmikan Capital. We invest in the junior mining sector, which has had its challenges, but I think we're finally at the turning point here.
George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. Two things that are worth knowing about me. One is that I first wrote about gold back in 1972. I've been involved ever since. And the other thing was that I was on the little team of people that put together GLD 20 years ago. And those are the two most important things that you need to know about me.
My name's Alex Rovira. I'm the Managing Director at Brightstar Resources. Geologist by background, and then spent 10 years in investment banking, largely with the metals and mining sector.
Great. Thanks, everyone. And just to round it out, my name is Darrin Blumenthal. I'm with Amvest Capital. We're a natural resource-focused financial services firm based in New York City. As you can tell from my accent, I'm not from around here. I was born in South Africa, so I think that uniquely qualifies me as a gold investor or observer. I'll get right into it. Gold's been a strong performer in the last in the last 18 months or so, actually against traditional metrics, typically with a strong dollar or increasing real rates. Gold doesn't typically perform well. So some of these relationships have broken down. I'd be interested just in high-level thoughts from the panel in terms of what they think is driving the breakdown in that relationship and driving the gold price in the recent near term.
I think the most obvious thing is central bank buying. In mid 22, there was a decoupling of the real rates and gold price. It also coincided with the U.S. taking back some securities from Russia. So, I think central bank buying is driving that.
Yeah, so I'd point out that the relationship you mentioned the last 40 years, it was actually the opposite in the 70s. If you go back to the 70s, when rates went higher, it had the effect of devaluing the assets in the Federal Reserve's balance sheet. The Federal Reserve holds bonds. And so if you think about it, high rates means that the assets back in the dollar go down, which means the dollar goes down and gold went up. And that was a relationship. That's the normal relationship, in fact. For the last 40 years, it's been the opposite. The euro-dollar system meant that when the whole planet had dollar-denominated debt. So when rates went higher, it meant that non-U.S. people needed more dollars to pay their debts. And so gold perversely became anti-correlated. And the Wall Street analysts started saying that because gold has no income, when rates go higher, the opportunity cost goes higher and gold goes down. That's actually not correct. And as Colleen just mentioned, when the U.S. took the Russian foreign reserves, the market started reverting back to that normal 1970s profile where higher rates means that the Fed's assets are going down in value. In fact, the Fed publishes a quarterly report. They're sitting on over $1 trillion of losses. And more than that, they have $160 billion of operating losses because they pay out interest at the prevailing rates, but yet they own 10, 20, 30-year bonds that are fixed rate. So they have huge operating losses. And so the question is, what person in the right mind would want to buy the financial instrument of an institution that has growing capital and operating losses? And the answer is nobody, unless you have to. So U.S. allies might be holding treasury bonds, but all the countries that are either antagonistic to the U.S. like China or are on the fence like India are looking around thinking, number one, the U.S. stole Russia's foreign reserves, and number two, we don't need to hold this piece of paper that has no economic value, only political value. I'd make one final point, which is that the basis of the U.S. international power is the euro-dollar system, and not many people know this, but the euro-dollar system began when Soviet Russia in the 50s had U.S. dollars they did not want to deposit in U.S. banks. So they deposited them in European banks, and that was the origin of the euro-dollar system. So European banks had dollar deposits from Soviet Russia. They started lending them out, and that's what created the international dollar system. And so it's more than ironic that the Biden administration has absolutely no understanding of how the world actually works, stole the Russian reserves, is basically undermined the foundations of the Eurodollar system. And Putin actually made this point in the Tucker interview, that is the basis of the U.S. economic power. And the Biden administration torpedoed it unknowingly. And so now we're seeing that unwind. I think that it means that when the market actually starts to price the dollar according to the economic value of the Fed's assets, we will see dollar prices a lot higher.
Oh, that's a lot to.
I was born in 72, by the way.
Then you probably weren't reading what I was writing in 1972, I'm sure. And you're lucky, because that was when I was full of certainties, right? I've learned a little humility along the way. Look, we'll mention central bank buying. I think that that's definitely been a very important factor, but it's important to remember that emerging market central banks have been significant buyers of gold for their official reserves for 14 straight years. They hit an all-time record in 2022. I spent most of last year warning people not to expect to match that record. We came within about 1% of it, so I've had to eat my words this year. And then when we saw first quarter figures just a few weeks ago, it was the largest first quarter net purchases by central banks in history. So it looks like we could well be on the way to another record this year. So that's very much been very, very important. I think that some of the political reasons that you talked about are definitely involved in that, no question about that. Booting Russia from the SWIFT system was widely regarded as us deciding to weaponize the international payment system, and it gave an awful lot of people pause. There are a couple of other things that are going on, though, and I think it's important to mention those. More recently, that we've had the long-term trend in central bank buying, which is definitely going to continue. I see no reason for that to come to a halt whatsoever. But in addition to that, we had an exceptionally strong first quarter gold demand in China. And I'm not just talking about the People's Bank, although they were a significant buyer again, but the consumer in China, who's very suspicious of the stock market there, even more suspicious of anything to do with real estate, and I think for very, very obvious reasons. And so the Chinese consumer and investor has turned to gold. The Chinese consumer is buying gold as an investment, both bars and coins and locally based ETFs. And the consumer is buying a lot of gold jewelry as well. And China and India regularly vie for the number one position in who's the biggest gold consumer in the world. The Indian economy is going like an express train right now. They're up around the 8% a year GDP growth, something we'd give our eye teeth for in this country, or in Western Europe for that matter. So I think that jewelry demand has also been very, very important. And the investor seems gradually to be coming back into the gold business, having been largely absent for a good deal. So I think for a good deal of the last few years. So I think you put all of those together, and you come to this very unusual situation where a month or so ago, the S&P 500 seemed to be hitting an all-time high practically every other day. And that's a risk-on asset. Bitcoin, I would regard as the ultimate risk-on asset, was also hitting record highs. And gold, which I regard as the ultimate risk-off asset, also hitting all-time highs at the same time. It's really rather difficult to parse that. I think the issue really was that there were a number of investors out there who were a little concerned about this enormous degree of enthusiasm for risk that investors were showing across the board, whether they're investing in the S&P or in cryptos. And I think that persuaded a number of people, including myself, to up our exposure to the risk-off assets, to up our exposure to gold.
Got it.
Look, I think there's also some very compelling answers there, and I certainly can concur with all of them. I think for me, as a managing director and CEO of a company that's ultimately exposed to the gold price and our revenue line from production, I think the record gold price obviously clearly very beneficial for us, but we probably haven't even seen the true tailwinds. At the moment it's the central bank buying, it's geopolitical concerns and tensions, but this is against the headwinds of the interest rates and the inflationary data that we keep seeing. So I'd be certainly hopeful that we continue to see the demand side of the equation that George was just touching on through that central bank buying and the middle market buying. But ultimately, once the Fed starts to tackle the inflation with interest rates, I think that's when we start to see further tailwinds ramping up.
Got it. So just to continue on that theme, while we've seen the gold price performed very strongly. We've seen a disconnect between the gold price and the physical and the underlying equities. I guess, George, you could give us some stats, but I don't know the exact numbers, but there's been net outflows, I believe, from the GLD and from many financial gold assets versus the physical, demand increases from the East and from central banks. Does this continue? At what point does this change, and why would it change?
I don't think it continues, because if it does, I'm probably going to be out of a job fairly quickly. I think that one of the things that has happened, and the World Gold Council put their finger on this when they released their first quarter figures, was that the number of institutions, family office type institutions, but primarily in the emerging world, so very large, very wealthy families, whether in the Middle East or in Southeast Asia, have been preferring to put their gold investment into a way that is not necessarily transparent to the authorities. So they've been buying large bars of gold, 400-ounce London Good Delivery bars, such as backs every central bank's reserves and backs GLD. They've been buying these large bars, which for reasons I don't quite understand, don't seem to show up as part of the analysts' surveys of bar buying. Most analysts look at official coins and small bars of up to 1 kilogram, but they don't look at larger bars. They don't look at that kind of investment. And there's been a lot of that, I think, mostly in countries where many investors regard the governments as being prying eyes, and they want to keep their buying quiet, and they want to keep it secret. So rather than showing up in the 13F filings for GLD and the other available gold ETFs out there, they've been buying bars. How much longer that continues, I don't know. But the interesting thing is, after a year or so of fairly steady redemptions in GLD, we've started to see a turnaround. We've started to see a very pleasant mix of some redemptions on some days, but also an equal number of creations coming up as well. And I think that's an encouraging sign from my point of view.
Right. I'll take the other side of that question, which is that if we cast our mind back a couple of thousand years to China, their problem was they had very good copper mines, very bad gold and silver mines, which meant that copper formed the currency of China for thousands of years. And the emperors tried to free the copper for industrial purposes. That's why they invented paper money. And the paper money kept hyperinflating. It was a disaster. But during that time period, the Chinese exported silks and spices. The Romans loved the stuff, and the Romans paid with silver. So silver's been leaking to the East for thousands of years. In fact, the British did the same thing. The British like to buy tea, which you drink, and they pay for it in silver, which is why this British got the Chinese hooked on opium, because you can grow opium and create a bilateral trade of consumables. And if we think about China in that context, the Chinese never absorbed enough gold to create a gold standard. They were still on silver standard in the 1930s, because that's all they had, essentially. And so the U.S. is basically repeating the experience of the Romans and the British, in that they ship us trinkets that expire. We are shipping them now gold. We don't think we're doing that, but that's what they're using our dollars for. They take our dollars and they're redeeming them for gold. And so you always see gold traveling from consumers to savers. And that is why gold is going to the East, and why that will continue going to the East, because that is the general trend of what is happening, has been happening for a couple of thousand years.
Maybe just moving into the equities. We're investors, equity investors largely over here. Maybe can we discuss some reasons as to why, given the gold price run, investors should be looking at equities? Do they screen for the portfolio managers on the panel and for the miners? Do you feel like the outlook going forward is going to be better in terms of potential profitability, and then the potential rewards from the market in terms of that profitability?
Yeah, look, I think so, absolutely. So in a post-COVID world, obviously and I'll talk to an Australian context, but I'm sure it's global, but costs were a huge part of the industry, and essentially the gold price increases were met pretty rapidly with, or exceeded by, the cost inflation. We saw that across diesel, across labour, across access to infrastructure, and ultimately there was a period there for a couple of years where the whole Australian gold sector didn't make any free cash whatsoever, and I think ostensibly that puts investors offside. What we're seeing now is that costs are starting to get a bit better of a handle on it on the cost line, and with the recent uplift in the gold price, you can start to see it in some of the recent quarterly filings from the ASX gold producers, all starting to make significant free cash. So what we are seeing now is that producer landscape starting to re-rate, and you've seen it from the top down. What we haven't seen yet is that liquidity and that interest falling down to the juniors. And I think the explorers and the developers in Australia and Canada are still very much unloved. And I think despite the gold price at record highs, it's a conundrum. And I think ultimately what we need to see is gold producers being good custodians of capital, not doing stupid M&A, making money, returning money to shareholders, via dividends or buybacks, and actually, starting to generate a return for people. Because ultimately, if you just asked an outsider on the street what they think about buying gold stocks, I think, well, that's a bit of a silly idea. So I think that's probably incumbent on the industry itself to really deliver those returns to shareholders.
I think Alex has put his finger on a lot of very important issues. I think a lot of people make the mistake of thinking that the gold mining company stocks should move in line with the gold price. The gold price is only about half of the inputs into company stock price performance. Gold mining companies are subject to exactly the same kind of factors that tech and pharma and financials are subject to: management skill or ineptitude, and we've seen plenty of both; success in mergers and acquisitions, as Alex says, or failure. Which part of the globe are they in? Are they in a good place, or are they in Venezuela, for example? There are a number of other different things that tend to affect the stock price performance rather than just the gold price. So just because gold goes up doesn't necessarily mean that companies producing it are going to go up to the same extent.
But I think to the point of there's margin compression. Until you stop seeing margin compression, there's no reason to want to hold gold equities. I mean, we've seen gold hit its all-time highs. Equities are nowhere near that. I think they're trading at trough multiples in terms of EV to EBITDA or price to cash flow, however you want to look at it. So as you start to see margin expansion, I think that's what will actually trigger people actually wanting to come into the space. That's my theory.
And what we've seen so far in this space is that the companies that have attracted capital from the industry, so M&A or big companies taking big positions in juniors, they've done very well. But juniors that need to raise external capital, it's still not there. From the companies we see and talking to brokers in Canada, people still aren't writing checks to junior companies, so the senior ones can get them. And we live in a funny market whereby the retail traders determine the stock price, and the institutions come in at a discount to that price. And so you really need the retail guys to show up to push that stock price up so they can attract capital at decent terms. And the retail guys aren't there. And I think part of the problem is that the main retail pikers in this space are Canadians and Australians, and they have variable rate mortgages. And so a lot of the cash that would speculate in these little junior companies and push their prices up just simply isn't there. Now, at some point, the economics of a lot of these companies command are so compelling that the cap will find them. Gold moving from $1,800, where it was only 7 months ago, today is extreme difference. And at some point, the value will be discovered, I'm sure. But the mechanism of how it happens and where the capital comes from, that's still a bit murky. But certainly the industry itself is making enough cash flow that you can reallocate it into the space and pick up the good projects. I will also point out that if you think about the gold mining industry, especially the junior space, for the last 10 or 25 years, there have only been 3 windows when you could finance it in any decent terms. That was 2009 and 10 and 11, 2016, and then 2020. And so the amount of capital available to develop projects has been very scarce. And what that means is that we're living in one of those National Geographic extreme environments where only the really crazy bacteria survives. Right? The people who have survived are very few and far between, and very hardy. And that's a good thing for current investors because it means as times get easier, there are so few projects that have been developed or started over the last little while. And every time one gets acquired, there's one fewer of them. So I think at some point, there'll be a scramble, as there always is in a resource industry, when people realize, oh my goodness, there's so few left, and it takes such amount of time and capital to develop a new one, we better buy the ones that are available now. And I think the people who are investing in the space now are going to get the benefit of that transition when it comes.
I'll just touch on Coille's point again, if I can, with respect to margin expansion. One of the things that is always important to look at is respective producers' hedge books. And it's a big thing down on the Australian Stock Exchange with respect to some of the producers and their hedge books. And obviously with the gold price increase, you're not really experiencing the full uplift in that. And it's something that, astute investors do look at.
Maybe that's one for the panel in terms of, do you think gold miners should be hedged?
I think it depends on the stage of development. I think if you're a single asset producer and you're starting up your first mine, you've taken on a lot of debt, probably makes sense to have some. If you have 5 mines, probably don't need it as much. That's my perspective as a PM. I think it depends on the risk profile of the asset.
Yeah, I agree. If you're hedging to make sure you pay your debt back, that makes a lot of sense. But the mandate should be to get rid of the debt and then not hedge after that.
Yeah, I think the mining companies should probably talk to their bankers about this. With a lot of projects, the bankers are actually insisting that the bank loans that they've made, that at least those loans be covered by hedging arrangements for new startups. That, to my mind, makes an enormous amount of sense. But I don't really see, as Coille says, I don't see the point of a mature producer with a number of mines in operation. They are in effect already hedged in a lot of different ways if they have more than one mine. So I don't really see the point in them actually hedging, because hedging does depress the price. There's no question about that.
Daniel, you're describing a environment in which gold discoveries and assets are becoming more scarce and production's becoming potentially slow because of the lack of capital. Those are typically good reasons for M&A in this space. Does the panel think that, like we've seen in copper, it feels like gold has similar dynamics, not a lot of new discoveries, lack of investment? Do you think that is going to lead to increased M&A in the space?
It already is. I mean, and the M&A over the last few years have been mostly giant companies merging to get scale, and they've been selling off the smaller mines that they don't want anymore. So there's actually, M&A has generated a net increase in developed projects, which is one reason why gold miners haven't had a lot of success on the equity side. I think we're finally starting to see aggressive intermediate companies show up and start buying development projects or taking big positions to fund development projects that will reduce the number of projects available. I also think that if we look back to the previous cycle, a lot of the big mining companies made terrible M&A mistakes. And then the cycle turned, they have to raise equity, sell assets is a disaster. And so they get naturally CEOs who are accountants or have that perspective, and they don't want to be risky. They want to make sure that investors get a big return. And Barrick's made almost no acquisitions because they have such a high barrier to acquire something. They haven't acquired anything. Well, now they're being left behind, right? The gold price is running and they didn't buy anything. And so what will happen eventually, as it always happens, they'll eventually fire the CEOs who are too passive and get some aggressive guy in who knows all the bankers, and they'll lever up and they'll do it again. So we're not there yet, but that's where that cycle naturally leads to, and that's a lot of fun for equity investors when that starts happening.
I would also point out that intermediates and seniors now have clean balance sheets. I mean, from 2011 to say 2020, they were pretty levered. So now you're starting to see cash accumulate on their balance sheets, and there's inflation, and boards don't want to slow down, and you see that in market valuation. So if you can project growth, you get a better valuation. So I think as companies delever, you're going to get more and more M&A, as you typically do at the bottom or the top of the cycle.
I would say just a couple of issues. I think the first one is that the mining companies have been spending record amounts on exploration and development, whether it's greenfield or brownfield around existing sites, and they are just not coming up with gold deposits, new gold deposits, at the rate that their shareholders would like them to. Shareholders want to see growth, not just sustained production, and it's actually rather difficult for the miners to sustain production, even though they're spending record amounts on it. And of course, the environmental lobby is making it harder. Nobody wants to find a gold mine in California anymore, for example. I remember Harry Conger 20 years ago telling me that one of the mines that he discovered there cost $100 million more to mine because of environmental issues and having to satisfy the environmental lobby. So nobody wants to do that anymore. So there's that the gold miners are not performing in the way that their shareholders want them to. The other thing, I think, probably a decade ago, most gold mining companies figured out that it was a lot cheaper to go mining on Wall Street than it was in Nevada or anywhere else that you would actually do that. It was a lot cheaper to go buy production rather than to go and find it for yourself and develop it for yourself. So this is to Dan's point, I think, and to Coille's as well.
Got it. So a few things we haven't touched on, and maybe if anyone had thoughts in terms of drivers for gold. A lot of people talk about the US debt and confidence in the dollar, and I think that leads me maybe to, as we close the session out, I can smell the beer. What everyone's forecast is for gold and then equities, and if they would prefer to be in gold equities or gold physical.
Well, I think last year I guessed 2,400 and you laughed at me. So
actually, yeah, we will put that in. Why don't we have a gold estimate for the next year in New York?
Low, you mean?
Next year in New York. So 12-month gold price estimate. And I hope someone from 121 is taking this down. There we go. So we can we'll have a scoreboard next year.
I guess I'm finally bullish on the gold price. I think we'll see Fed cuts, maybe not this year, but early into next year. Historically, when you've had Fed cutting cycles, gold and silver, so particularly silver, rally out of that. So I don't know. You want me to pick a number?
Sure.
3,000.
Okay, it's bullish.
So I'm
my
pretty
job.
consistent in my views, and that is, if we go back a couple hundred years now instead of a couple thousand years, and we look at the Bank of England, which was the dominant central bank of the globe, and you could go to the bank and deposit gold and get pounds, or go to the bank with pounds and get gold. So the inflow and exflow of gold from the Bank of England was market-driven, not policy-driven. And the market insisted on a 1/3 coverage of the rest of the Bank of England's liabilities. So private banks, public banks in the 19th century all had a third backing by gold. And even the Federal Reserve from 1914 to about the 1950s had a 50% gold backing. Now, you can no longer go to the Federal Reserve with your dollars, they give me gold, which you couldn't until the 30s. But you can go to the coin store and you can buy gold that way. So in my mind, the way this credit cycle ends is the market prices gold at a number that makes the Federal Reserve's balance sheet balance. And to get to that 1/3 backing, which the market has insisted on for hundreds and hundreds of years, puts gold at $9,000 an ounce. So that to me is an unwinding of this credit bubble. In fact, if you go back to the average backing that the market insisted the Fed have, that's 50%, you get to $15,000 an ounce. Now that may sound crazy, but if we think about the gold rally from 1971, when gold was $35 an ounce, to the peak at $875 in 1980, right? That was a 35 times increase. And at that price, the gold actually overshot at $650. The Federal Reserve was entirely backed by gold. The U.S. is back on our gold standard in 1980 when the gold price hit $650. And that number today is around 30,000. So that's not a stable price. That's not an equilibrium price. In my mind, the equilibrium price today is around $9,000 and $10,000 an ounce. And it'll happen very suddenly. Can't tell you when, but it will happen. It'll happen very subtly. And that is where we're headed. And you think about what the gold equities will be worth in that environment. And that's when you get that sort of 70s feeling of watching something go up 10, 20, 30x. I think that's the end game here. And with Biden and Blinken in the White House, I think it can happen sooner than most people think.
Speaking as somebody who remains earthbound, the team that I'm part of at State Street just put together our mid-year review of the outlook. We did pretty well last December when we predicted that gold would trade between 1950 and 2200, and that was exactly where gold traded for the first quarter. Our bullish case, which we suggested if things get better for gold, and they certainly did because inflation turned around and started to go back up again, and the situation in the Middle East got dire worse with direct conflict between Iran and Israel. So our bullish case said gold could trade between 2200 and 2400, which is essentially what it did in Q2. So we're pretty pleased with that, but obviously you've got to go back and take another look at those numbers. The team that I hired is all less than half my age. This is why my technology works, by the way. It's like being surrounded by nephews and nieces. It's really helpful. But they're all very, very enthusiastic. So I see my job as basically trying to squelch them and to try to keep them as earthbound as I am. So we're looking for probably, possibly as much as another 10% appreciation, but gold's already up 13 or 14% year to date. The consensus on the street is suggesting anywhere from 10, 15 to 20% more in the price, which I think is the kind of thing that you're talking about, Coille, as opposed to Dan's stratospheric suggestions there. I think that it would be wonderful if that happened. I don't think it's going to happen, but I might even go into retirement if that would happen. No, I think that, we're looking for some further appreciation in 2024. Turning my head to 2025, I think Coille's 3,000 is perfectly reasonable as a suggestion for some point in 2025. I would not argue with that at all. But the nice thing is I don't have to put my forecast for 2025 together until December. So I've got plenty of time to give that thought and to see whether I'm going to let my boats rise from the surface of the earth.
In 72, what was your gold price target for the end of the decade?
In 72.
When gold was $35 an ounce, where did you think it was going?
I was quite confident it was going higher, Dan. I had no idea.
875?
I had no idea. I bet against it going through $1,000. And I thought 875 was pretty damn good and collected my bets and thought, I'm going to keep betting against the gold price when everybody gets that enthusiastic. My benchmark has always been when you get in a cab in an airport, doesn't matter what country, what city you're in, you get in a cab in the airport, you get chatting with the driver and he says, so, what line of business are you in? You say, well, I'm in the gold business. If they asked you what the gold price is going to do, that's a good time to buy. But if they tell you what the gold price is going to do, then sell it to them as fast as you can.
I agree with that.
So is there a number there?
Yeah, I think there's a possibility of 2,700 this year. And I think that we have to bear in mind the possibility of 3,000 for next year.
There you go. I was going to say 2,750. There's no science at all, and we'd be very happy if it was that. But in the current gold price environment, producers should be making lots of money. If it goes to 9,000, like Dan says, we'll be laughing.
And just to clarify, that means a total disintegration of the Federal Reserve and the credit bubble. It's not a cyclical thing. That means that's
the world's ended, but we have $9,000 gold.
Well, the world ending, but remember, the world ended in the 70s. It was unpleasant. We had to watch the Incredible Hulk on TV. It was pretty grim, but the world didn't end, and the similar things could happen.
Some backtracking.
Got it. So, do we have time for questions? Should we open it up to the floor?
As this is a gold panel, I'm going to ask a silver question, which does have, of course, gold implications. So this is mainly for George, although I'd be interested to hear what everybody has to say. As we come up to the settlement on the nearing contracts on gold and silver, it's my understanding that while there's enough gold for settlement, even though it's all been highly apothecated, and silver, there just is not enough. And so my question is, are we looking at a force majeure, or are we looking at a forced financial settlement, either for cash or some other instrument? And then my second question, just a general question, comments on the election of Gloria Sheinbaum yesterday in Mexico and the implications for mining. Thank you.
All right, I'll take the first part of the question. I'm probably going to duck on the second part, but to the rest of the panel who are much more better informed than I am about that. Look, the futures trading on the commodity exchange is only a small part of the actual trading in gold. I think that people get very excited about, there are 5 times as many contracts available as there is gold available. There are 12 times as many futures contracts available on the dollar as there are physical dollars in existence. Nobody gives a damn about that. It's just that people get very, very worried about gold when they don't understand that most of what is happening on the futures markets in gold and in silver is that people are hedging positions that they've taken in the over-the-counter market. That's most of what is actually happening on the commodity exchange. So these are not people who are going to be wanting to take physical delivery, which is why the exchanges maintain a relatively small stock relative to the amount of trades outstanding. I think that really is a major misunderstanding of the market, that most of what is being done is simply people who are hedging positions they've taken in the over-the-counter market, hedging those on the futures exchanges. And I'm going to pass on the Mexican president.
I I think that doesn't change the fact that silver has been in deficit for the last 4 years, and we're expected to be 200 million ounces short by the end of 24. To your point, I think there's still obviously interest in the silver price. In terms of Mexico, 25% of the world's production comes out of Mexico. So, and an open pit or underground has been permitted recently. So that's not particularly constructive for the supply side. It's good for the demand side. I think it's just pointing to that mining is getting more challenging, particularly in South America.
I think the Mexican peso today might have answered your question. It's in a tailspin. I mean, you have a lady who my understanding is World Economic Forum. She's urban left, not country left. And I read this morning she's a climate scientist. So
from Berkeley.
So you got the climate scam thing going. So that doesn't bode well. And my understanding is she may have earned a supermajority in the legislature, which would allow her to redo the Constitution. So I think it's pretty scary stuff.
If you assume a gold price of 2,700 or 3,000, with apologies to Dan, how would you think about the future potential for equities? And should gold equities have something like a market multiple, an S&P multiple? Or at one time, like you mentioned, these used to have the optionality of the upside. Gold used to have optionality, and these companies used to trade on a very expensive basis. Yeah. But in the current environment, and to Dan, just as a second question, Biden desperately wants to get reelected, and the government wants to assume to be solvent. Gold prices of 9,000, they would fight tooth and nail, I would imagine, because it presumes an insolvency or some kind of corruption of the financial system. If you comment on that.
Okay, if I'll take the first part of that. I think, for most of my life, I think the conventional wisdom was that if the gold price goes up 1%, gold mining stocks will go up 5%. The problem, of course, is that's leverage, which is wonderful when things are going up, but it bites you. And I won't tell you where it bites you, but you know where it bites you when it goes down, meaning that when the gold price goes down 1%, then the mining equities will tend to go down 5%. I think the real problem and one of the reasons why I own gold bullion in the form of GLD as part of my portfolio, a significant part of my portfolio, is that among many things that does for my portfolio, one of the important things, I believe it offers me some protection against potential weakness in the equity market. And my problem with gold mining equities is that whenever the general level of the stock market turns down, gold mining equities remember that at bottom they are equities and they tend to go down with the general level of the stock market. I know the stock market has been going like an express train for a long period of time, and that worries me because at some point everything comes to a stop and will turn around and go in the other direction. I cling to the outdated belief that markets are probably still cyclical, and I think I'm probably going to be borne out by that too. So I worry about the possibility of a downturn in the stock market, which could significantly hurt the stock prices of the gold mining companies.
So two thoughts for you. One is gold is more sensitive to monetary conditions than costs of gold mining are. And so if you think about QE, the original QE, gold went crazy, right? And the margins exploded, and then costs caught up. Same thing happened in 2020, right? The QE for COVID, gold went up a lot, margins blew out, gold mining stocks went crazy, and then the costs started creeping up. And we're seeing the same thing now, right? Gold is going higher. The costs haven't really gone up yet. And so you're starting to see margin expansion again. And as long as we stay in these cycles where gold is, loitering around $3,000 an ounce, if the Fed can keep the cycle going, and I'm not saying they can't, I'm not saying we have another cycle in here, I think you would see gold go higher, margins explode, gold's companies really, really well, and then costs creep up, and you have that reaction again. When I give that $9,000 or $15,000 gold prediction currently, is really based on history, finance, and the assets of the Federal Reserve. I mean, basically, the Federal Reserve is a balance sheet. Like you have a balance sheet, a bank has a balance sheet. They have assets and liabilities. And a unit of their liability is called a dollar. That's what it is. And so if you think about how central banks react, like in Israel, when when the attack came, right? The Israeli currency collapsed. And what did the central bank do? They sold assets and bought the currency to stabilize it. That's what they could sell assets, right? And that's what Japan is doing to support the yen. They sell assets and they buy the yen. So turn your attention back to the Fed. What do they own? They own 30-year Treasury bonds, which they bought during COVID, that have a fixed rate of interest at 2.5%, and they have mortgage-backed securities, which the duration goes higher as rates go higher because no one refinances, right? So they have a toxic brew of assets. And so if the dollar starts declining, what can they sell to buy back dollars? The answer is nothing. They have absolutely nothing. So as a balance sheet, as strictly a financial balance sheet matter, you look at the Fed's balance sheet, you look at their losses, you look at what happens to their assets at higher interest rates, it's really, really ugly. And you say, well, again, where does gold have to go to trade to make that balance sheet balance? In terms of your Biden comment, you're absolutely right. I mean, Janet Yellen figured out a way for the Treasury Department to print money, right? She drained the reverse repo facility into the bill market, and this created tons of inflation, even though rates are higher. And people like me thought, well, I mean, the world can't stand rates going to 0 to 5%. Well, it can when the Treasury Department is printing all this money, all these trillions of dollars. So actually, we've been able to forestall that. But think about, again, the international position of the dollar. The dollar is powerful because we can buy commodities and goods from other countries we don't manufacture ourselves. Mm-hmm. And that is what keeps the American way of life going. That's what makes Walmart work, okay? And so it's why Argentina doesn't work, because no one has pesos externally. They have the same monetary policy we do. The difference is that there's no external Argentine debt that requires non-Argentines to have pesos, right? And so my point is that as the world backs away from the dollar internationally, not only because of the political risk that we're going to steal our assets the way they stole the Russian assets, but also the economic risk that a dollar represents a basket of assets that's really, really impaired. At some point, the world's going to say, we don't want that piece of paper anymore. And that's when you get a reset, a sudden revaluation of gold that the market is going to do, the way it did in the late 70s, to say, hey, we're going to put it at a price that makes that balance sheet balance. And the more money the Fed prints to help out their political masters, the higher that nominal price goes. And that's the end. That's not a cyclical thing. That's the up and down which we're living in. That's the end game. That's where we're headed.
Sorry, Dan, that equilibrium price, what did you say that was?
Well, currently 1/3 backing is 9,000 and half backing is 14. Now, if you really want into it, we have 2 minutes left. In that era, going in the 19th century, banks held on their balance sheet commercial bills, 30-day commercial bills, not 30-year government bonds. So that ratio can go a lot higher than that, and it will.
Right. Any other comments on gold equities in terms of outperforming? Maybe Alex should have to, you're representing a gold miner.
Yeah, well, I'd like to think that it goes up quite strongly if we can maintain those margins. I mean, it's quite logical if we can keep the costs where they're at and the gold price goes up and you've got exposure to the gold price, then logically thinking the equities should be re-rating. I think the liquidity returning to the space on the back of the elevated gold price at the moment is great. I mean, all the gold producers, intermediates, juniors, and explorers have struggled for capital, certainly at the smaller end. So I think there's probably a lot more room to re-rate for some of these junior companies, ASX, TSX.
I think that closes it out. We're just on beer o'clock, so I'd like to thank everyone on the panel. Very interesting discussion. I'd like to see in 12 months where we're at. I hope Dan is not right, because if he is right, then we're probably in a lot of trouble. But thanks, everyone.